Welcome back to OC Insurance Academy. In today's lesson, we'll learn how insurance policies become legally binding contracts. You'll also discover the responsibilities of both the insurance company and the policy owner, along with key legal concepts that frequently appear on the state licensing exam. An insurance policy is much more than a piece of paper. It is a legal contract between the insurance company and the policy owner. In exchange for premium payments, promises to provide specific benefits if a covered loss occurs. Every insurance contract clearly defines the rights and responsibilities of both parties. Every legally enforceable insurance contract must contain 5 essential elements. First is the offer. The applicant usually makes the offer by completing and submitting an insurance application. Second is acceptance. The insurance company reviews the application and accepts the risk. Third, the applicant pays the premium and the insurer promises to provide coverage. Fourth, both parties must be legally competent to enter into a contract. Finally, the contract must have a legal purpose and comply with all applicable laws. Insurance contracts have several unique legal characteristics. A contract of adhesion means the insurer writes the policy and the applicant either accepts or rejects it. An aleatory contract means the value exchanged between the parties may not be equal. A conditional contract requires both parties to meet certain obligations before benefits are paid.
Insurance contracts are also based on the principle of utmost good faith, requiring honesty. Most insurance policies are personal contracts, meaning they insure a specific individual rather than property alone.
The policy owner has several important responsibilities. They must provide truthful information when applying for coverage. They must disclose all material facts that could affect the insurer's decision. Premiums must be paid according to the policy terms. If important information changes, such as an address or beneficiary designation, the insurer should be notified. When filing a claim, all information must be accurate and complete. The insurance company also has important responsibilities. It must evaluate applications fairly and consistently. It must issue policies that clearly explain the coverage provided. When a covered loss occurs, the insurer must investigate the claim and pay benefits according to the policy provisions. Insurance contracts rely on utmost good faith. This means both the applicant and the insurance company must act honestly. Insurance companies must also comply with all state insurance regulations. If the applicant intentionally hides important information, the insurer may deny a claim or cancel the policy. Honesty is essential to maintaining a fair insurance system. Let's look at a real-world example. Maria applies for a health insurance policy and accurately answers every application question. She pays her premiums on time. Several months later, she requires surgery. Because she fulfilled her responsibilities and the loss is covered, the insurance company pays the claim according to the policy. This is how a properly functioning insurance contract protects both parties. Let's look at an exam tip regarding valid contracts. Which of these is not an essential element? Is it A, C, consideration, or D? The correct answer is commission. Remember this for your licensing exam. The 5 essential contract elements are offer, acceptance, consideration, competent parties. Commission is not a required element of a legal contract. Let us review what we have learned so far. What makes an insurance policy legally enforceable? That is correct. A valid legal contract is essential. Question 2. Which element requires both parties exchange something of value? Correct answer, C. This represents the consideration in a contract. Question 3. Which principle requires applicants to provide truthful information? A. Utmost good faith. C. Assignment, waiver. Correct answer, B. Question 4. Who is responsible for paying premiums? Beneficiary, C. Policy owner, D. Underwriter.
C.
Excellent work. Today, you've learned the legal foundation of insurance contracts and the responsibilities shared by both the insurer and the policy owner. These concepts are essential not only for passing your licensing exam, but also for building trust and professionalism throughout your insurance career. Congratulations on completing Lesson 4.
Insurance policies are legal contracts. Every valid contract requires 5 essential elements. In our next lesson, we'll explore insurable interest, representations, warranties, concealment, and fraud. Critical legal concepts that every licensed insurance professional must understand.
Thank you for learning with OC Insurance Academy. We'll see you in the next lesson.
Welcome back to OC Insurance Academy. In our previous lesson, we learned how insurance contracts are created and the legal principles that make them enforceable. Today, we're going to examine 5 important concepts that every insurance professional must understand: insurable interest, representations, warranties, concealment, and fraud. These concepts are not only important in the real world, they are also commonly tested on insurance licensing examinations. Let's begin with insurable interest. Insurable interest means that a person has a legitimate financial or other recognized interest in the continued life, health, or well-being of another person. In life insurance, insurable interest must generally exist when the policy is purchased. For example, a spouse generally has an insurable interest in their spouse. A parent may have an insurable interest in a child. A business may also have an insurable interest in an important employee whose death could create a financial loss for the company. Remember this important exam concept. The requirement for insurable interest is generally measured at the time the policy is issued. Imagine a small business. Imagine a small business depends heavily on one key employee. If that employee dies unexpectedly, the business could suffer a significant financial loss. Because the business has a legitimate financial interest in that employee's continued life, the business may have an insurable interest. This is key person insurance. Next, let's discuss representations. A representation is a statement made by an applicant that is believed to be true to the best of the applicant's knowledge. Information provided on an insurance application is generally considered a representation. For example, an applicant may answer questions about their health, occupation, tobacco use, or lifestyle. The applicant is expected to answer these questions honestly and accurately. A warranty is different from a representation. A warranty is a statement or promise that is guaranteed to be true. Because warranties carry a stronger legal obligation, students should pay close attention to the distinction when preparing for the licensing exam. Here's an easy way to remember the difference. Think of a representation as information provided honestly based on what the applicant knows. A warranty carries a guarantee of truth. Now let's discuss concealment. Concealment occurs when a person intentionally withholds a material fact that should be disclosed to the insurer. The key word here is material. A material fact is information that could influence the insurer's decision to accept the risk, reject the application, or charge a different premium. For example, imagine an applicant knows about a serious medical condition, but deliberately fails to disclose it when applying for life insurance. That intentional failure to disclose important information may constitute concealment. Not every mistake on an application is automatically concealment. Concealment involves intentionally withholding a material fact. This distinction is important. An honest mistake is different from deliberately hiding information.
Insurance fraud occurs when someone intentionally deceives an insurance company or another party for financial gain. Fraud can happen during the application process or when filing a claim.
For example, someone might intentionally provide false information on an application, submit a fake claim, stage an accident, or falsify documents. Insurance fraud is illegal and can result in serious legal and financial consequences. As a licensed insurance professional, you have an important responsibility.
You must communicate honestly and accurately with clients. You should never encourage a client to hide information, falsify an application, or submit a fraudulent claim. Professionalism, ethics, and compliance are essential parts of a successful insurance career. Let's review the 5 key concepts. Insurable interest means there is a legitimate interest in the person being insured. A representation is a statement believed to be true.
A warranty is a statement guaranteed to be true. Concealment involves intentionally withholding a material fact, and fraud involves intentional deception for financial gain.
Question 1. When must insurable interest generally exist in a life insurance policy? The correct answer is B, when the policy is purchased.
What is a representation? A statement believed to be true?
Question 3. What is concealment? The correct answer is B, intentionally withholding a material fact.
Question 4. Which action is an example of insurance fraud? C. Submitting a deliberately false claim, or D. An address. The correct answer is C.
Excellent work. In this lesson, you've learned 5 critical legal concepts that every insurance professional needs to understand.
Remember, understanding these principles will help you protect your clients, comply with insurance laws, and prepare for your licensing examination.
Congratulations on completing Lesson 5. In our next lesson, we'll begin exploring life insurance fundamentals and the major types of life insurance policies, including term life, whole life, and universal life. Keep studying, keep practicing, and we'll see you in the next lesson with OC Insurance Academy.